Hello and welcome to another episode of finance tutorials, I guess. So in the last chapters, we have introduced the way the stock price moves as a geometric Brownian motion. So it can be modeled like this, and the way to compute option prices as an average of the value of the options at expiration. Today, we are going to study this stuff more in depth. So essentially, we have priced options as if they were insurance. So what does that mean? Let's say this would be the option prices. So let's say the stock price today it's 100, and it can go up or down. And we have seen that depending on the distribution of the stock price, like we have a certain volatility, and we can have a growth rate or a drift. So in this this new parameter of the normal process can be positive, 0, or negative. So if it's positive, then the distribution. So if it's 0, the distribution of the stock prices will look something like this. Well, not necessarily like this, but on average, it will be 100. So we can have prices that are higher than 100, lower, but most of them will be around 100. So on average, the price of the stock after some time will be 100. If this is for a 0 growth. Now, if the growth is 10% per year, it will be skewed something like this. So it will go to 110 on average. And for this, minus 10% per year, it will be something of this. Let's say this is 90. So let's run. So I'm configuring this job. Price options as insurance. Let it run for a while. Okay. And let's see the log. Okay, so we can see that I'm calling this the growth process because the stock price tends to grow by 10% per year. The stagnation process because it stagnates around it. So the growth rate is 0, and the decline, it declines by 10% per year. And running the simulations, we can see that the growth process has a mean of 110, so it went up by 10% on average. The stagnation process remained at 100, and the other one declined by 10% in a year. And we can also take a look at how the distribution actually looks. So let's take a look at the process that goes down 10% in a year. Let's see a chart. And, well, it's not. Let's delete these things because there's very few of them. And we can see that it's around 90. So it actually sort of what I've drawn here. So the process that declines by 10% a year, it on average ends up around 90 after a year, but it can also very well go to 200, but it's unlikely. So how do we price options under these circumstances? Well, an option, what is an option? So if options were insurance, which they sort of are, let's say they would be, I don't know, cars. So let's delete this. So let's say you're an insurer for cars, and this is, let's say, the base price, and I don't know, a driver has a damage. Let's say the stock price is somehow ended up at 120 after a year. Well, for a call options, this means you'll have to pay the difference. So this thing, the difference between 120 and 100. So you'll have to pay 20. So this is the damage that you have to pay for a car. Now, if other car goes to, other stock goes to 150, you'll have to pay 50. Now, if the option, if the stock goes in this direction, so let's draw the distribution. So about in the stagnation process, about half of them will go up, half of them will go down. So for those that go up, you'll have to pay higher and higher damages. For those that go down, you don't have to pay anything. So this is what the price of an option is. So what in an insurance mindset, what is the price then? So a car insurer prices his insurance at the average cost for him. So how much do I have to pay on average if the options, if the stock behaves in a certain way, it has a certain distribution. So it's fairly intuitive that let's take a look again at the means. So the process that has the stagnation process that stays around 100, well, I only have to pay for this part up. So when the stock is in this area, so if you compute the average of those of the values that you have to pay around 9.98, around 10. So this is the value, the insurance value of an option. Now, if the stocks tend to go up, so on average they are around 110, you'll have to pay more on average. So obviously the value of the option will be higher, like 16. You can calculate it and it will be 16. And the other way around, if the stock goes down, so most end below the strike price that is the base of your payment, you'll have to pay less. So you have to pay only this area, which is around 5. And so if the options were, if the only argument for pricing options would be the insurance argument, then depending on how your process, your stock process behaves, its growth, times of growth, times of stagnation, or times of decline, you would have different prices for options. This one is for zero growth, this for a higher if the stock tends to go up, and lower if the stock tends to go down. But if we look at the Black-Scholes price for an option and introduce the exact same parameters as here, so volatility 25%, 1 year, so 1 year to expiration, stock price right now 100, strike price 100, and calculate, we get 9.95, just like I got for the stagnation process, pretty much, 9.95. How about the delta? 0.56, 0.55, so pretty much the same. We'll discuss later what delta is, but you see that Black-Scholes doesn't have a drift parameter or a growth parameter, so it doesn't care at all about that, and it only shows one price, which corresponds to a drift of 0. So what is happening? Why is it like this? Well, the reason for that is the whole trickery in options pricing, and it's the fact that options are not priced as insurance. The argument for pricing options is not the insurance argument, but it's the arbitrage argument. So in the following, I'll present in a way which I hope to be easier to understand what does arbitrage means and how it works with options. So let's start briefly to present what classic arbitrage is. So arbitrage with stocks, with commodities or what else, you have the same product on two different markets, and I've drawn here New York and London. And let's say the ton of apples trades around $90 in New York and around $110 per ton in London. This means you can buy it pretty much with 90, sell it pretty much with, let's say, a few cents around it. And here's a few cents around it. So essentially, that's why I'm saying trade price and not buy or sell. They are very close and don't matter when the difference is that much. So what do you do at this point? Well, you buy apples from New York and sell them in London. But the important thing is that you signed a contract to do that. So obviously, it will take some time to transport the apples from New York to London or whatever stock you have. But the contract, you sign it instantaneously. So when these two markets have different trade prices, you sign the contract now, and in New York you have a contract of buying 1 ton of apples with $90, and in London you have a contract of selling 1 ton of apples with 110, and you can have whatever quantity you want, more than 1 ton. And once you have those contracts signed, at some point you'll have physical delivery of those stocks or commodities. But the thing is, arbitrage, classic arbitrage, just means having different prices for the same product on probably different markets, because it's unlikely you'll have different prices for the same product in the same market. And it can be the other way around. Like, so now I've pictured apples, and you can have oranges the other way around. So oranges are cheap in London and expensive in New York. Case when you buy them from London and sell them to New York. So same principle, different. Whatever product you have, you sign the contract and then deliver later if the difference in prices is big enough. This works if the product is the same, but what happens when you have different products? So it's fine to have apples or oranges or different stocks, IBM, Apple, Google, what else? But if you have Apple in London and Google in New York, well, you can't do anything because they are not the same product. So classic arbitrage is meaningless for this. So now intervenes the genius of options trading and the whole idea behind it, and why it's not insurance and why it's arbitrage. So what does Black-Scholes do? Not necessarily Black-Scholes, options pricing in general. So essentially it transforms apples into oranges. So it allows you to do this, to trade apples for oranges, which normally you couldn't do. So assume in this case orange is an option and apples are the stock. So normally you couldn't exchange stocks for options because they are different products. But with a very clever technique, you can take slices of an apple and assemble them like integral in mathematics. An integral of slices of an apple makes a whole orange, and it's effectively genius. I mean, like, the guys who thought of this deserve a Nobel Prize. So how it works? Well, it starts with the realization that option price is a function. It's a function of a stock. So the orange, which is the option, depends on the apple, which is the stock, which is obvious because the price of an orange at expiry depends on the stock. So it's stock minus strike for a call option. So we can model this as a function. Y is the orange, X is the stock, and F is the function. So we know that at expiry, this function is effectively this. So stock price minus strike price of the option, and for a call option is this max of stock minus strike and 0. So this is the price at expiry, and obviously during the lifetime of the option, it will also depend, it will be a function. Honestly, we don't know at this point what it is, but we know that it is a function. So we know orange is a function of apple, or option is a function of stock. And what next? Well, we use Taylor series expansion, which says the following. Differential of the orange price is differential of the stock price times the derivative of that function. What does this mean? So the small change in option price, so let's say option now is Y0, option price now is Y0, and stock price now is X0. And after some time, a day, let's say, the stock has a new price, X1, and the option will obviously have a new price, Y1. And Taylor expansion says that this difference, the difference in the option price will be the difference in the stock price times a certain quantity, which is the derivative of the function that we don't know yet, but know it's a function of the how much the option depends on the stock, how much the orange depends on the apple. And I visually depicted it like this without the Q, because the Q is essentially how much. So it's more obvious here. We have different days, day 1, day 2, day 3, and we have the slices of the orange, so the difference, the change in option price in each day, and they depend on the change in stock price, but taking smaller or bigger chunks of that apple. So that's why this Q before, so which is actually this derivative. And if we sum all these chunks of the orange, in mathematical terms, we integrate the differential of the option price. So integral of differential of orange is integral of differential of stock multiplied by the derivative of option with respect to stock. And what is this? This is precisely the orange. So if we integrate the differential of all the slices of the orange, we got the whole orange, and adding different quantities of the stock over different days, we got precisely this. So starting with the original argument, the arbitrage argument, the options are trading now at $220 per ton in New York, and apples are trading at 110, which is useless to compare directly against oranges. But if we apply this technique of taking slices of apples over the time of the option, let's say the option has a maturity of 1 month or 1 year, and each day or each month, we do this integration. And we calculate now that the cost of the orange that we will create out of apples will be 200. So then we have an arbitrage. We sell options in New York and cover it by actually buying apples from London, and it only costs us 200, while we sold them at 220, and we did an arbitrage. So this is the arbitrage argument for options, and a very clever technique to do that. And that's why options are not insurance. Options are based on arbitrage. And in the following, I'm going to present the rigorous mathematical derivation of all this stuff, but this was the intuitive way of how this works. So we have discussed an informal presentation of options arbitrage and the argument on how it works. And now we are going to be a bit more rigorous and look at the mathematical derivation of all this stuff. So what we have discussed so far, what the heck is this? So what we have discussed is that we can reassemble the price of an option by integrating its Taylor series expansion, which is pretty much this. So integral of the differential of the option price is integral of its Taylor series expansion. So differential of the stock price times the derivative of the option price with respect to the stock price. And what does this mean? So this stuff is I forgot how it's called, but essentially it's integral of the differential. It's the primitive of the function, which is actually that function. So we have option price at expiry minus auction price at inception equals, and what is an integral? An integral is just a sum. So it's depending on how precise you want this sum to be, you can, let's say we have a function and the integral is just a sum at different intervals. So the more often these intervals are, the more precise it is. So we can say, we can sum this stuff each day. And this means that the price of the option at expiry minus the price of the option at inception, it's the sum of the difference between stock prices, so stock price in one day and stock price in the other day times a certain quantity. So again, what does this mean? Let's say we are buying stock. So we are buying stock, which means it's minus here. So we are buying stock today and we are selling stock tomorrow. So since we are buying it, we are losing money. So we are losing minus this quantity. And tomorrow we are making money. We are making plus this quantity. So essentially by buying stock in one day and selling stock the other day, we have this differential. And quantity is just how much stock we buy. We can buy more or less. Okay, and how does this arbitrage works? Well, we have this formula, which is mathematically precise, and we don't know yet what the current price of the option is, what the price should be that cannot be arbitraged. But what we'll prove in the following is that if this price, so if the actual price on the market is not exactly this price, trades at the margin M. Let's say you can buy an option which is lower than this, the price that it should be. Let's say Y0 should be $10, but you can buy the option at $9. So margin is $1. So what do you do then? Then you buy the option. So you buy it at $9, not at 10. So you pay that much for it. So it's with minus here. So you pay $9. And at expiry, let's say in 1 month or 1 year, you sell it at the respective price, how much it values there. It could be more, it could be less. So you have a P&L. The P&L, it's this. So the price that you sell it in a year, let's say, and minus the price that you pay for it now. And to make an arbitrage, you replicate the option, and so you sold this, and now you have to buy this, the stock, to have something to arbitrage it with. So you buy the stock, but using this formula, so a little slice of apple every day. And we have proven that if you do that, the overall value that you will get, it's exactly this. But since we are selling it, no, so we sold the, no, we bought the option here. And if we sell the stock, then this stuff is with minus. So if we buy it, we use plus. If we sell it, we use minus. So the P&L in of doing this stock replication, it's going to be this stuff. So if we add these two P&Ls, we have the option prices canceling each other, and we are left with the margin. So always the P&L of the option trade plus the P&L of the delta hedged stock, so of the replicated option using stock, it's the margin, which means that the option prices that don't trade at exactly the fair price Y0 can be arbitraged, and you are left with this margin. And now the question that remains is, what is this Y0? So we have to absolutely must know what is the option price now. And we have seen that we can use the insurance argument to price options. This Monte Carlo pricer encapsulates that. And depending on the growth rate of the process, we get different prices, but which is not good, because we know that it is not the correct price. We will be arbitraged ourselves. So which one of these prices should we use, and why we have to use this one where the growth rate is 0? So we'll figure this out in the following. So again, this is the replication formula, and integrating, we get this. So we have the stochastic differential equation of how the stock price moves, which is this one. We have discussed it, geometric Brownian motion. We've discussed it earlier. And also we have, for a call option, we have this contract price of the option at expiry. So when after a time t, let's say 1 year, you get the difference between the stock price at that time, which I'm going to call forward price, and the strike price, if the stock price is higher than the strike for a call option. Otherwise, you get 0. And we also have proven that for this process for the stock price, we can compute directly the stock price at expiry as with this formula. On average, it's this thing, which means that if we use the insurance argument, obviously this average at expiry depends on the drift mu, so the option price would depend on it. Now, we have talked about Taylor series expansion. So the whole technique of pricing of arbitraging option, it's based on having the option expressed as a Taylor series and then integrating it. Okay, so what is the differential of the option price? Well, the rigorous derivation is using Ito lemma, and it looks like this. And regrouping the terms and noticing that this term is actually this, the stock price, and eventually we are left with this. So it looks a lot like dy, the differential of option price this is the x differential of stock price times the derivative of option with respect to stock plus this stuff. So it's almost this, but we have this stuff getting in the way. Or do we? Actually, we don't, because this is the whole idea of how to price an option. So what do? We say this stuff equals 0. This is a partial differential equation that has no uncertain term, so no stochastic Wiener process, which can be solved exactly by various techniques like find difference methods or directly using the Black-Scholes formula. And it gives us this price. So solving, let's see, so using the Black-Scholes, which is just solves this stuff and gives us a y0 of 9.95. And we have noticed here that we get the same thing for, so the same price if we use the expected value pricing, or Monte Carlo price, or insurance argument pricing with a growth of 0. But why the growth rate doesn't matter, we'll see here. So what do we do? So let's consider that mu equals 0. So let's set it to 0. If mu is 0, we got rid of it here. So actually, no. So okay, so we've set this PDE to 0, and we've obtained the value of the option at moment 0, solving this PDE. So using this Ito expansion, if we set the PDE to 0, we are left with this. So exactly the Taylor expansion, the simpler stuff from here. So we integrate it, and now we can expand the x. So we replace the x with the full formula of the geometric Brownian motion for the stock process. So then we are, after a bit of manipulation, we are left with this. So the option price at expiry minus the current option price equals integral of this plus integral of this. And what we do, we take expectations. So if this stuff is valid, it's also valid in expectations. And we can take this expectation using any mu, any drift, but let's take it for mu equals 0. So for hypothetical, it doesn't matter what the actual real mu of the market is. We'll, just for the sake of computing, we'll take it, this stuff being 0. And then what we have, so since this stuff is multiplied by mu, it disappears. So this part of the integral will be 0. Now, integral of a Wiener process multiplied by anything is going to be 0. So this is, again, something well known. Doesn't matter whatever the mu is, this stuff will always be 0. And we have taken mu equals 0. So this stuff is also 0. So then the right-hand part is going to be 0. And on the left-hand part, we are going to be left with the expected value of option price at expiry minus, well, expected value of the stuff now, it's stuff now. It doesn't matter. It's no expectation. It's just a value. So we have this equation which gives the option price now, which is the option price calculated using this PDE. It's also equal to the expected value of the option at expiry, but when mu equals 0. So that's why it doesn't matter whatever the the drift is. When we calculate the option price, we always have to plug in mu equals 0. So this is an explanation of why the drift price doesn't matter for the option pricing. And that's another reason why the Black-Scholes formula was so celebrated, because it says that eliminates risk. So when you trade directly in the stock, then you are exposed to the risk of whatever this growth is. It could be positive, negative, or 0. It's not that certain that it's going to stay this way. So if it was positive for a while, it would change course and become negative. But when you trade options, you don't need to worry about this anymore, because it's completely plugged out. So it doesn't matter anymore. All that matters is the volatility. Okay, so we have introduced the theoretical method of options arbitrage. So this means that you can replicate the option price by trading different quantities in the stock over time. So and we are going to test this in practice. And the problem that we had was that what pricing model to use when the stock can have so the stock price can have different processes, like it can have a growth rate positive, negative, or 0, but we have proven that we have to use a growth rate of 0. So the expected value of the option should be computed as if there would be no growth in the stock process, even though there can be actually in the market process has a growth, but the pricing that we use must not have one of them. So that's why we are going to study this experimentally. So we are going to have several pricing models, one of them being Black-Scholes, where we are going to use the Black-Scholes pricing model, which gives the same prices as here, for instance. And we have encapsulated the pricing using expectations. So expectation of the option value at expiry using this Monte Carlo pricing model, which in turn uses a Monte Carlo pricer, which uses a process, and this process can have a growth. So we can test. So we are going to have the market process having whatever growth. We're starting with 0, and we are going to do this replication of option prices. So this integral using different models for the expectation. So using a positive growth, negative growth, or 0. Actually, probably we should use the market growth. Okay. So anyhow, so we are going to have different models here, and we generate trajectories for the stock price. So for now, let's just generate one. So one simulation. Yes, so nothing to remove, just run it and see what we get. And grab this part out of it. Delete. Format cells. Date. Okay. And this is our stock price trajectory. So we generate random trajectories for the stock price. And for each of these trajectory, we are applying this replication technique, and we calculate our net asset value at any point in time using different pricing models. So let's see how this looks. So, well, they are different. Okay. Now we are going to run this for a lot more simulations, like 100 of them, and comment this part because it only adds noise. Okay, and do a little bit of debugging and see what happens. So let's just one simulation for start. So we start, so we go with stock prices day by day. We have a maturity of 1 year in this simulation. Okay. And we haven't created the strategy. We haven't traded the option yet. So what do we do? So essentially, we buy or sell an option. For buy, we use positive. For sell, we use negative quantity. So what option? Well, the strategy matures in 1 year from now. It's an ATM at the money option, which means that the strike price equals the current stock price of the stock. And we are pricing it using the different pricing models, in this case, Black-Scholes. So with Black-Scholes, we have a price of 9.95 and a delta. What is the delta? Delta is this important thing. It's this derivative of option with respect to the stock, and how we calculate it for Monte Carlo pricer. So for Black-Scholes, it's simple because we have a formula. For Monte Carlo, we use the finite difference formula for calculating a derivative. So this formula, so price if the spot is what it's currently, and if the spot goes a little bit up, we have a new price, and the derivative is this thing. So we can calculate it numerically. And we do a trade, in this case, buy an option. Also, how many options we buy, well, depends on how much money we have. So if we have $100 and the price of the stock is 100, then we can buy one option. Otherwise, we could buy more or less options. Like we have $1 million, we can buy a lot more options. So, but in this case, okay, so it's easier to have here 1 for buy 1 and -1 for sell 1. Okay, so this is essentially we have bought an option priced using the Black-Scholes pricer, and let's see if we use a pricer that takes into account the growth rate of 0.1. The price is higher, it's 16, so it's different from the Black-Scholes. And the delta is again different because should be around 0.5. If we use the model which has a zero growth, and we have discussed that this is exactly equivalent to the Black-Scholes model, then we have the same price and the same delta. as Black-Scholes. And if we would have a negative growth, it's a different price. Okay, we build a portfolio of this strategy. Okay, we are not hedging every day. We hedge once a month. In case of a year, we can hedge once a day, but it takes a lot more time to simulate. And we do the rebalancing, which is exactly this thing. And let's see how it works. So, okay, we need to rebalance. So we calculate our delta, which is 0.5. So, which means that we must have 0.5 contracts of the stock. So what's our current position in the stock? It's 0. And we need to sell. So because we have bought an option, we have to sell the stock. So we need to sell minus 0.654 times the multiplier. So we could have 10, 100, 1,000 times this multiplier. Okay. This for each one of them. Now the day has passed. We don't rebalance every day, so let's put a breakpoint after a week. So a week has passed. What's our delta now? It went down 0.4. And remember, we started with minus 0.54. So our new hedge position, so we started with a minus 0.54, and now we must have minus 0.4. So we need to get rid of some of the stock, which means we need to buy 0.14 stock times the multiplier. So this is pretty much what all this integral of derivative times delta stock does. So you just have to rebalance the position in the stock over time and always hold the opposite of the options delta position. So this is in practical terms, all this mathematical fuss. Okay, and do this stuff for 1 year, rebalance every month, and in the end, let's see what happens in the end. So in the end, the strategy expires. So let's put a breakpoint when it expires. Okay, so it expired, and we need to close the position. What does this mean? Well, we have what position? We have a position on the option. We have bought one option at the price of 9.95. We need to sell it, so -1. And what's the price of the option now? Well, the price of the option now is 0. So we paid 9.95 for it, and we sell it at 0, so we'll have a loss of minus 99.95. So we lost money on the option. But because we have replicated the option position using stock, it should be counterbalanced by the stock. So we have another position in the stock, which is now at minus 0.19, but we have accumulated P&L over time. So we bought, sold. So we made money, lost money, and overall, our P&L so we lost, remember, lost around $9, around $10 on the option and made $6 on the stock. So it's not exactly equal as it theoretically should be here, but it's only equal if the hedge frequency is infinite. So if we hedge more often, then we get closer to this stuff. But again, hedging infinitely often has other problems. It only works in theory, because in practice you pay transaction costs for hedging. So you can never hedge infinitely often. So you have to strike a balance between how often you hedge, so how accurate this formula is. But let's go further. So we lost some money on the option, made some money on the stock, and overall we lost some money, but not as much as we would have lost if just trading the option simply. So this is for the Black-Scholes position. All the other positions have we've closed everything, and let's look at the okay. So we have the P&Ls for the different pricing models. So Black-Scholes, we lost 3.56. The Monte Carlo, so the expectation model using drift of 0 has essentially the same results. And if we use high, so higher drift than the market, we lose more money. If we lose lesser drift than the market, we make more money. We lose less money, so we make some money in this simulation. But let's run it for 100 times. So no, let's run this stuff 100 times. And we have different results. And at the end, we'll collect the statistics for them. Okay, so what are the statistics? So for Black-Scholes, on average, we don't make money, we don't lose money. So this is nothing compared to the standard deviation. So if we plot these P&Ls, we'll get something like this. Which one? So if we would plot the P&L, it would be something like this: 0 and minus 2.26, minus 2.26. Now this is the standard deviation, so that's about it, minus 2.26. This is 2 or 3 times that. Anyhow, so it's around 0 for the proper model. Using expectations, we have about the same deviation and about the same mean, so 0. And the growth, so if we use a positive value for growth, we lose money on average. And for this one, we make money on average. But that's not good because we need to be at 0. Because we lose money when we buy an option and make money when we sell an option. But what if we do the opposite trade? So instead of buying the option, sell the option. So simulate this. Okay, and Black-Scholes and not the Monte Carlo, the proper Monte Carlo model are still around 0. Now, and the wrong models have reverted. So for this one was losing money, now it's making. This one was making money, now it's losing. So you need to be at 0 because you know that anything beyond 0, this margin, you do the proper trade and you keep it. Otherwise, it's just random stuff. Okay, and now let's have another model for the market. So again, buy the option. And instead of the market, let's say, would have exactly the same growth as this model. So we actually need to use this one for proper calculation, which is same as Black-Scholes. But what if we would use the same as the market? What would happen? And this one obviously has a negative. What the heck? Okay, so what we got now Well, Black-Scholes and the Monte Carlo model are again around 0. And even though we used the same growth rate as the market, we are still losing money with the growth model. And in the decline model, we are making money. So it makes no difference whatsoever. Let's use market growth negative. And in this case, this model has the same growth rate as the market, but still doesn't matter because it's still mispricing. It's not working the way it should be. So the only models that work are the Black-Scholes if you use the closed form formula, or the Monte Carlo model with a 0 growth rate. So I guess this is pretty much it. So this were a simulation, an experiment to prove how all this replication formula works and why we have to use a mu of 0 in order for this arbitrage technique to work. So this is it for now, and in the future we'll study more actual strategies that are applied on actual historical market data and move from theory to practice. So thanks for listening. See you next time.